They attempted their strongest move. They deployed their most powerful arsenal weapon and failed to hit the target. For 4 decades, the silver market has operated under one terrifying acronym's shadow, the CME, the Chicago Mercantile Exchange. We've heard repeatedly that the exchange dictates pricing. We've been warned that excessive silver price acceleration triggers rule modifications, margin increases, and forced speculator liquidations. We witnessed this during 1980 when the Hunt brothers fell victim to rule alterations. We observed it during 2011 when 5 margin increases across 9 days crashed pricing from $50 to $30. We saw it during 2020. Margin increases represent the nuclear option, the system's declaration that festivities have concluded. Yesterday, Monday, January 12th, the system activated the nuclear button. They raised margins 15%, hiking contract holding costs nearly $6,000. They exercised every available power to engineer collapse. But today, Tuesday, January 13th, 2026, we're examining charts defying every financial history textbook. Examine the screen. Silver pricing isn't declining. It isn't stagnant. It trades at $88.95, up $3.78 daily. That's nearly 4.5% gains following punitive margin increases. This defines failed assassination. Banks attempted rally termination. They tried breaking buyer psychology. They wanted you awakening this morning, seeing red charts and panic selling. They wanted leverage washouts. Instead, markets observed margin hikes and laughed. This resilience represents the most bullish signal ever witnessed. When markets ignore negative news, bull markets exist. When markets ignore direct regulatory attacks, super cycles emerge. We're witnessing Teflon market birth. Nothing adheres to it. Suppression tactics working for decades are bouncing off physical demand armor. Understanding what just occurred requires examining the failed smash mechanics. Yesterday, when news broke, we saw dips. Pricing dropped to $80, $50. Algorithms reacted. Weak hands folded. For approximately 4 hours, it appeared banks had won, successfully capping prices at 85s. Then something miraculous occurred. Dip buyers stepped in. Who purchases dips facing margin hikes? Who steps before regulatory freight trains? Not retail Reddit speculators. Retail speculators fear margin calls. The entity buying dips at 83.50 doesn't care about margins. It's a cash-paying entity intending to remove metal from exchanges permanently. This validates our thesis that paper markets lost power. Margin hikes only affect traders borrowing money for price betting. It doesn't affect Samsung. It doesn't affect Reserve Bank of India. It doesn't affect Chinese solar manufacturers. When buying physical metal for industrial use, COMEX margin hikes represent irrelevant noise. Actually, it's a gift, knocking prices down for hours, allowing discounted inventory purchases. Banks inadvertently discounted silver for the very entities draining their vaults. They're feeding beasts they're attempting to starve. Observe the recovery. It wasn't slow grinding, it was V-shaped explosion. We moved from 83.50 to 88.95 in under 24 hours. That's a 550 move from lows. This indicates springs coiled tighter than ever. Every price pushed downward creates more violent rebounds. Volatility expands upward. We're now approaching $90. $88.95 is effectively $89, and $89 is merely rounding errors from $90. $90 represents historic levels, nearly doubling pricing from $50 breakout levels. It's the level where mainstream financial media can no longer ignore stories. But traps exist here, and I want warnings issued. When markets become Teflon, shrugging off margin hikes and regulatory attacks, they attract dangerous capital. They attract momentum chasers, hot money. We're seeing open interest building again. Speculators return thinking markets are invincible. This creates volatility setups. Banks failed with first margin hikes. Think they'll stop? No. They'll likely hike margins again. They might hike tomorrow. They might hike Friday. They might raise requirements to 20% or 30%. They'll keep hiking until something breaks. But here's the difference between 2011 and 2026. In 2011, silver was plentiful. Vaults were full. Shortages were purely speculative. Today, vaults are empty. We saw yesterday's data, 2.2 million ounces drained in a single day. You can hike margins to 100%. You can make leverage futures trading illegal. But if Samsung needs 10 million silver ounces for battery construction and only 5 million ounces exist in vaults, pricing reaches infinity. Margins cannot print metal. The failed $83 assassination exposed establishment weakness. It showed the world the emperor wears no clothes. The CME fired its bazooka, smoke cleared, and the silver bull still stood taller and stronger than before. This creates psychological feedback loops. Short sellers and banks are now terrified. They know their best weapons didn't work. They know they're defenseless. This fear leads to covering. We're seeing signs commercial banks are beginning capitulation. They're no longer attempting rally stoppage. They're attempting burning building exits. They're buying back short positions at $88 because they fear buying them back at $188 next week. This is short squeezes in purest form, panic exits by the very entities creating suppression. So, closing part 1, the message is clear. Systems struck back and systems failed. Pricing is $88.95. Trends are vertical and resistance is gone. But if banks losing control was the only story, we'd be looking at $100 next month. However, a second squeeze is happening simultaneously, a squeeze even more fundamental and much harder solving. While banks run out of paper ammunition, miners run out of physical rock. Our next deep dive section examines hidden futures market data. We'll analyze phenomena called backward rolling, technical terms representing physical panic. We have evidence traders are paying premiums to cut lines. They're jumping from March contracts to January contracts because they know waiting until March might mean silver's gone. Banks failed stopping pricing. Now miners are failing delivering metal. This is the double squeeze, and it's getting very, very tight. If part 1 addressed noise, margin hikes, headlines, price volatility, part 2 addresses signal. Noise is what they want observed. Signal is what they're hiding. While mainstream media obsesses over $88 price tags, wondering about bubbles, forensic accountants inside futures markets examine data far more terrifying than pricing itself. They're examining CME open interest reports, specifically trader behavior holding March delivery contracts. In normal healthy markets, futures trading follows predictable rhythms called rolling forward. Holding January delivery contracts without wanting physical metal because you're a speculator or bank means selling January contracts and buying March contracts. You kick cans down roads. You roll positions forward into futures. This is how games have been played for 50 years. But Friday, continuing into Monday, and today, Tuesday, January 13th, the game stopped working. Rhythms broke. We witnessed phenomena known as backward rolling. Look at data we uncovered in CME report minutia. March 2026 silver contract open interest declined by 450 contracts. That's normal, people closing positions. But where did those positions go? Did they roll forward to May? Did they roll forward to July? No, they rolled backward. January 2026 contract open interest, the contract in immediate delivery right now, increased by 135 contracts. February contracts increased by 50 contracts. Net math shows roughly 355 contracts. Sitting comfortably in March, decided March was too distant. They sold March positions and bought January and February positions. Let's translate this into physical terms. 355 contracts represent 1,775,000 silver ounces. That's nearly 2 million silver ounces that just cut lines. Imagine standing in line for new iPhones. You have tickets guaranteeing phones in March. You're sitting comfortably at linebacks, but suddenly you hear rumors. You hear March shipments might be canceled. You hear factories stopped producing. What do? You run to line fronts, you find someone holding today's tickets, and pay massive premiums to swap spots. You move from future to present because you don't trust futures. This is exactly what's happening on COMEX right now. Industrial buyers and smart money wholesalers are looking at March delivery windows and seeing black holes. They're seeing force majeure possibilities. They're seeing depleted inventories we discussed in part 1. And they're panicking. They're willing to pay extra fees, extra commissions, and extra storage costs just to get warehouse receipts today. This queue jumping is the ultimate physical shortage sign. In markets with plenty of supply, nobody pays for early delivery. Storage costs money, insurance costs money, security costs money. You only take early delivery if not getting metal risks outweigh holding costs. We call this the bird in hand trade. A bird in hand is worth 2 in bushes, or in this case, an ounce in vaults today is worth 10 ounces in March futures contracts. And look at delivery notices. Reports show another 170 January delivery notices issued. This means 170 traders didn't just buy contracts to speculate. They stood for delivery. They said, give me the metal. Usually in delivery months, open interest collapses as traders exit. But here, open interest rises even as deliveries happen. Bathtubs are draining, but people keep jumping in. This creates traffic jams in delivery mechanisms. Warehouses try shipping metal out, but new buyers step in. demanding immediate allocation. The backward rolling of 1.7 million ounces signals that just-in-time supply chains have officially snapped. Trust is gone. Trusting exchanges means rolling forward. Trusting miners means rolling forward. Trusting systems means rolling forward. Moving backward is distrust acts. It's no confidence votes in exchange solvency. And this brings us to why. Why are these sophisticated traders so terrified of March? What do they know about supply chains that retail public doesn't? They know silver rivers are drying at sources. We're hearing reports, and this connects directly to ghost supply concepts, that mining companies themselves struggle meeting commitments. We know refining capacity is maxed out. We know Latin American labor strikes threaten production. But backward rolling suggests something even more immediate. It suggests the float, the available inventory moving between London and New York, has disappeared. Usually, if New York runs low, London ships metal over. If London runs low, Zurich ships metal over. It's a global shell game, but right now shells are empty. The Shanghai magnet we discussed earlier has sucked all loose inventory into Asia. No backup supply exists to ship to New York in March. Traders see this. They see shipping manifests. They see empty vaults. And they realize waiting until March might hand them checks instead of bars. On COMEX, a rule exists. If exchanges cannot find metal to deliver, they're allowed cash settling. They can write checks for contract dollar values and tell you to go away. For pure speculators, cash settlement might be acceptable. You made profits. But for industrial users like Samsung, cash settlement is disaster. You cannot build batteries with checks. You cannot coat solar panels with wire transfers. Samsung needs metal. Tesla needs metal. So they're rolling backward, grabbing metal before exchanges declare cash settlement events. They're securing physical assets while technically still possible. This is why pricing is $89. It isn't just speculation, it's premiums being paid for certainty. Buying silver at $89 today isn't just paying for metal. You're paying for possession certainty. You're paying to escape futures exchange counterparty risks. Divergence between paper pricing and physical reality is closing, but it's closing in the most violent way possible. Paper markets try catching up to physical buyer desperation. And think about leverage. The margin hike we discussed in Part 1 was designed flushing out leverage longs. But entities rolling backward aren't leveraged longs. They're fully funded buyers. You cannot shake them out. You cannot scare them. They're on missions to secure strategic resources. This data point, the 1.7 million ounces moving backward, is the smoking gun proving squeezes are real. It proves this rally isn't a Reddit-driven bubble. It's a bank run driven by the world's largest capital pools. So where does this leave us? We have markets where banks tried smashing prices and failed. We have markets where physical buyers are jumping queues to get delivery. Now we have markets where inventory bleeds by millions of ounces daily. This is the double squeeze. Banks are being squeezed from above by pricing. They're insolvent on their shorts. Miners are being squeezed from below by demand. They cannot dig fast enough. And in the middle, pricing has nowhere to go but up. $89 is just today's panic equilibrium point. But what happens when January contracts expire? What happens when we roll into February? If backward rolling continues, if we see another 2 million ounces jump queues next week, systems will lock up. Warehouses will simply run out of registered bars to assign. At that point, we enter force majeure. Exchanges will declare emergencies. They will limit trading to liquidation only. We're not there yet, but data says we're getting closer every single day. Backward rolling is the tremor before earthquakes. Our next deep dive section examines the miner drought. We'll explain why mining companies cannot simply turn on taps to save COMEX. We'll look at geology, ore grades, and timelines. Banks are powerless. Exchanges are powerless. And as we'll see in Part 3, even miners are powerless to stop this. The silver is gone. And markets are finally pricing in zero reality. We've analyzed bank failure to suppress pricing. We've analyzed trader desperation jumping queues in futures markets. But to truly understand why silver pricing stands at $89 and refuses to blink, we have to look upstream. We have to go to sources. We have to look at mines. In standard economic textbooks, there's a simple rule. High prices cure high prices. Theory is that when commodity prices rocket to $89, miners will rush to dig more from the ground. They'll flood markets with new supply and pricing will come back down. It's the natural supply and demand cycle. But in the 2026 silver market, textbooks are burning. We're witnessing supply inelasticity events. This means no matter how high pricing goes, miners physically cannot produce more metal fast enough to matter. Why? First, you have to understand geology. Silver is a nature freak. Unlike gold, which is mined for its own sake, over 70% of the world's silver comes as byproduct. It's accidental discoveries found in lead, zinc, and copper mines. This is the byproduct trap. If you're a lead miner and global economies are entering recession, which they are, lead demand falls. You cut back production. You lay off workers. You dig up less rock. And because you're digging up less rock, you produce less silver. It doesn't matter if silver is 89. It doesn't matter if silver is $500. If your main product is lead and lead is crashing, you're not going to expand mines just to get a little extra silver dust. So precisely at the moment when the world screams for silver, the primary silver production engine is stalling out due to global industrial slowdowns. Supply curves are inverted. Higher silver prices are being met with lower total output. But problems get worse. Let's talk about silver being mined. Where's it going? For decades, flow was simple. A Mexican miner dug up silver. They sent it to refiners. Refiners made bars. Bars went to London or New York. COMEX warehouses filled up. That river ran dry. Flow has been hijacked. We're confirming reports of massive off-market transactions occurring directly at mine gates. This is ghost supply phenomena. Imagine you're the CEO of a major Peruvian silver mining company. You usually sell your concentrate to trading houses that put it on COMEX. But this morning, your phone rings. It's a Samsung SDI procurement executive. Or maybe it's a Chinese state-owned enterprise representative. They make offers you cannot refuse. They say, we'll buy 100% of your production for the next 2 years. We'll pay spot price plus $5 premium. We'll pay for shipping, but you must ship directly to our Seoul or Shenzhen factory. Do not send it to COMEX. What do? You take deals. It's guaranteed revenue. It eliminates hedging costs. It's no-brainers. But what does this do to global markets? It creates shadow inventory. Silver is being mined, yes, but disappearing into private hands before ever hitting public markets. It never shows up in COMEX warehouse reports. It never shows up in London vaults. To New York traders, it looks like production dropped to zero. This is why we're seeing the inventory drain we discussed in Part 1. Registered COMEX silver isn't being replenished because fresh supply has been privatized. We're effectively seeing silver supply nationalization and corporatization. And this brings us to force majeure rumors. In commodities world, force majeure is the legal escape hatch. It allows suppliers to break contracts because of unforeseeable circumstances. Usually this means hurricanes or wars, but we're hearing whispers that miners are preparing to declare force majeure on their bullion bank contracts. Their argument, we physically cannot deliver metal you shorted because we've already sold it to industrial partners. If this happens, if miners officially cut off bullion banks, short sellers are dead. They're short a commodity they cannot source. They cannot buy it from mines. They cannot buy it from vaults. They can only buy it from you, the investor. This is the double squeeze. Banks are being squeezed by screen pricing. Miners are squeezing banks by diverting metal flow. And let's look at timelines. It takes 10 to 15 years to discover, permit, and build new silver mines. 10 years. If we found solid silver mountains today, they wouldn't produce a single ounce until 2036. But backward rolling data tells us markets need silver today, in January, in February. There's a temporal mismatch. Demand is immediate. Supply response is a decade away. In that 10-year gap, pricing has to do the work. Pricing has to rise high enough to destroy demand. It has to rise high enough to force people to stop buying silver jewelry. It has to rise high enough to make people melt down grandmother's silverware. But as we established, industrial demand is inelastic. Samsung cannot stop. Military cannot stop. So pricing has to go to truly unthinkable levels. It has to go to levels forcing monetary holders to sell. At 89, are you selling? No, you're buying. Retail public is buying. So pricing isn't high enough yet. The minor drought is this bull market's fundamental bedrock. You can fix banking crises with bailouts. You can fix margin crises with rule changes. But you cannot fix geological deficits with printing presses. This is why margin hikes failed. Markets looked at paper smashes and said, that's cute, but where's the metal? The metal is in the ground and staying there or on ships to China. We're entering resource nationalism periods. Look at Mexico. Look at Peru. These governments are watching price explosions. Think they're going to let foreign companies extract their wealth for pennies on dollars? We expect to see higher taxes, export bans, and nationalization threats in coming weeks. Every time politicians in mining jurisdictions open their mouths, silver premiums will jump another $1. Ghost supply is real. Silver is vanishing from public eyes, and COMEX is left holding paper promise bags they cannot fulfill. Our final deep dive section examines the endgame. We're We're going to take chart resilience, backward rolling panic, and minor drought and calculate targets. $90 is imminent. $100 is the next step. But if miners really are tapped out, if rivers really are dry, we need to start talking about prices that sound ridiculous today but will look obvious in hindsight. We need to talk about three-digit reality. Banks failed, miners are empty, the public is hungry, the perfect storm has made landfall. We've arrived at the conclusion. We've dissected failed assassination anatomy where margin hikes bounced off markets like pebbles hitting tanks. We've analyzed backward rolling panic where institutional money pays premiums to jump queues. We've exposed minor droughts where supply rivers have been hijacked by industrial giants before ever reaching seas. Evidence is overwhelming. It's forensic. We're not looking at trading anomalies. We're not looking at temporary disruptions. We're looking at systemic pricing mechanism failures that have governed silver markets for 50 years. The double squeeze is in full effect. Banks are trapped from above, miners are trapped from below, and the only escape valve left is pricing. Now we must look forward. We must map out the territory lying ahead. Because once assets break all-time highs, once they enter price discovery, there are no maps. There are no chart resistance levels because we've never been here before. We're flying into vacuums. So where does this stop? Is $90 the top? Is $100 the top? To answer that, we cannot look at dollar pricing. As we've established, dollars are broken yardsticks. Measuring silver in dollars is like measuring bridge lengths with rubber bands. Rubber bands are stretching, so bridges look longer every day. Instead, we must look at relative value. We must look at relationships between the two monetary metals, gold and silver. Look at today's gold pricing. It trades around $4,731, up nearly $26 on the day. It's holding firm. It's the new financial system's anchor. Now let's look at the gold to silver ratio. Throughout monetary history, from the Roman Empire to the United States Constitution, the natural gold to silver ratio was roughly 15.1. For every 15 silver ounces in Earth's crust, there's roughly 1 gold ounce. In the modern manipulation era, that ratio blew out. It went to 80, 90, even 100 to 1. This was extreme suppression science. It meant silver was being priced as cheap industrial byproduct, not scarce monetary asset. But today, with gold at $4,631 and silver at $88.95, the ratio is approximately 52.1. Ratios are collapsing. They're reverting to means. If silver were to simply return to its historic monetary norm of 15 to 1 against current gold pricing, where would it be? Do the math. 4,631 divided by 15 equals $309 per ounce. 309, that's fair silver value in a world where gold is $4,600. At $88, silver isn't expensive, it's on sale. It trades at 70% discounts to its monetary parity. This is the catch-up trade. Algorithms know this. Central banks know this. When gold gets too expensive for average persons, capital flows into silver because it's the poor man's gold. It offers more upside. This is why I believe the move to $100 is not a question of if, but when. We're sitting at $88.95. We're effectively at $89. The $90 level is a psychological speed bump. It might offer resistance for an hour or a day, but given momentum, given backward rolling, it's likely to fall. $100 is the real barrier. Humans love round numbers. Triple-digit thresholds are siren songs for global media. When silver crosses $100, it will trigger frenzies. It will be on The Economist covers. It will be lead stories on nightly news. Your taxi driver will ask you about it. Your grandmother will ask you about it. That moment, the moment public mania truly begins, is the moment of maximum danger and maximum opportunity. It's the moment where shortages transition into bubbles. And bubbles are profitable, but they're volatile. So let's talk about exit strategies. I know many of you are looking at account balances today and feeling euphoric. You bought at $25, you bought at $30. You're sitting on gains of 200 or 300%. The temptation to sell is going to be overwhelming. You'll think, I can pay off my mortgage, I can buy a new car, I can take a vacation. But you have to be very, very careful. If you sell your silver for dollars, what are you actually doing? You're trading hard assets that are appreciating for soft currencies that are collapsing. You're trading cures for diseases. Dollars are not destinations. Dollars are victims. We're living through currency resets. Margin hikes, backwardation, minor droughts. These are all symptoms of currencies losing privilege. In every currency collapse in history, from Weimar Germany to Zimbabwe to Venezuela, those who sold gold and silver too early regretted it. They sold for millions of paper units only to find bread loaves cost billions of paper units a month later. So when do you sell? You sell when you can trade your ounces for income-producing hard assets. This is the ounces to acres strategy. Don't trade your silver for paper. Trade it for land. Trade it for rental properties. Trade it for businesses that generate cash flow. Trade it for energy infrastructure. Wait for the moment when mania is so high that real estate prices have crashed relative to silver. Right now, it might take 5,000 silver ounces to buy decent houses. In mania peaks historically, that ratio can drop to 500 ounces. That's the trade. You're swapping one form of generational wealth for another form of generational wealth. You're bypassing fiat currency entirely. But we're not there yet. We're at $89. We're just leaving launch pads. Ratios are still 52.1. We want to see them at 30 to 1 or 20 to 1. The week ahead is going to be the longest week of your financial life. Volatility will be nauseating. Banks failed with their first margin hike. Don't think they're done. They'll try again. They might hike margins to 20%. They might hike them to 30%. They might restrict trading to liquidation only as they did with the Hunt brothers. They'll try changing rules again. But remember today's lesson. The 15% margin hike failed. It failed because physical buyers ignored it. If they hike margins again, results will likely be the same. Temporary dips followed by violent recoveries. Why? Because you cannot margin call a shortage. You cannot regulate geological deficits. The only way to stop price rises is to find more silver. And as we proved in part 3, there is no more silver. Mines are tapped out, inventory is hijacked, so pricing must go up. It must go up until it destroys demand. It must go up until Samsung says, we can't build batteries anymore. It must go up until solar industry collapses. At $89, demand is not destroyed. It's accelerating. Therefore, pricing is too low. The double squeeze is a historical event. It's the moment where financial economy crashed into physical economy. You, the individual investor, are standing in wreckage holding the only thing that survived. Don't let them shake you loose. Hold your position. Secure your vault. Educate your family. This is not just about getting rich. It's about surviving transitions. It's about ensuring that when dust settles and new systems are built, you have a seat at the table. Banks lost, miners are empty, the public is waking up, the trend is your friend, and the trend is vertical. Welcome to the age of real money. Subscribe.